Japan, long seen as America's steadfast ally in Asia, has taken a bold step that Washington perceives as a direct challenge. The government under Chagaru Ishiba has openly declared it will no longer subordinate Japan's national interests to those of the United States. Instead, the top priority is protecting and revitalizing Japan's own economy. This shift in priorities is most clearly demonstrated by Japan's recent resumption of oil imports from Russia despite existing US-led sanctions. But this move is only one indication that Tokyo is increasingly asserting its independence from Washington's influence. Last month, Japan sounded a loud alarm about its surging national debt. The response from the United States? Silence. No financial aid, no public reassurances, no diplomatic support. This silence is especially striking given Japan's status as the world's largest foreign holder of U.S. Treasury securities, with assets exceeding $1.1 trillion. Under the economic strain imposed by Trump-era tariffs and ongoing trade tensions, Tokyo is now seriously contemplating selling some of its massive U.S. bond holdings. For the first time in over a decade, Japan is signaling it intends to put its own interests ahead of maintaining the historic alliance that has defined its foreign policy. This development is happening amid a broader global economic realignment. The world's reliance on the US dollar is waning, particularly among BRICS nations and over 20 additional countries that have joined their bloc. Brazil is emerging as a key player, seriously considering issuing and accepting loans denominated in China's yuan rather than in dollars. All of this is unfolding while the United States grapples with a staggering national debt approaching $37 trillion and a decreasing appetite worldwide for U.S. government bonds. Should the BRICS nations fully transition their financial dealings to the yuan, it could quietly but irreversibly dismantle the dollar-based financial system that has underpinned American geopolitical and economic dominance for decades. Yet most people remain unaware this process has already begun. For more than half a century, Japan has been Washington's most reliable partner in Asia, aligning closely with American policies and avoiding any actions that might jeopardize the relationship. But that era of quiet compliance is ending. Tokyo's recent decision to resume purchasing Russian oil is not only opposed by the United States, but was something Washington actively sought to prevent. This is a transparent, official government move to place Japan's national interests above international political pressure. Japan's first shipment of Russian oil since early 2023 consists of 600,000 barrels of Sakhalin blend crude, purchased by Tao Oil, a private refiner. This oil comes from the Sakhalin-2 project, which also supplies Japan with liquefied natural gas, LNG. The key issue is that the oil is a byproduct of gas production at the Sakhalin-2 plant. If Japan refuses to buy the oil, its gas supply could be jeopardized. Therefore, the government not only approved the oil purchase, but actively initiated it, despite the entire Western world shunning Russian energy sources. However, the situation is more nuanced. Japan's deal is proceeding under a temporary U.S. exemption, a special waiver that permits Tokyo to buy oil from Sakhalin-2 without violating sanctions, at least for now. This means Japan is essentially buying time while making it clear it will no longer wait for Washington's permission to sustain its economy. Adding another layer of complexity, the oil was delivered by the tanker Voyager, a ship currently under both U.S. and European Union sanctions. Under ordinary circumstances, working with such a vessel would be highly risky. But because of the temporary waiver, Japan will face no penalties this time. Furthermore, the EU does not impose secondary sanctions on non-European countries, which keeps the transaction legally permissible, though diplomatically awkward. One of America's closest allies is openly importing Russian oil aboard a vessel sanctioned by the West. This situation starkly highlights how Japan's energy predicament has deteriorated since the Fukushima nuclear disaster. With nuclear power largely sidelined, Japan relies heavily on LNG imports. Since oil is a byproduct of that gas production, Japan must maintain both to ensure energy security. When gas supplies are threatened, Japan is willing to accept compromises, even if it means weakening Western sanctions. If Tokyo can secure exemptions, it sets a precedent that other countries may pursue, gradually eroding the effectiveness of sanctions and offering Moscow a vital financial lifeline at a time when the US and its allies are trying to isolate Russia. What began as an energy transaction has evolved into a significant geopolitical signal. Japan's return to Russian oil exposes how fragile the West's supposed unity is when economic survival and national interests collide with political agendas. This may only be the beginning of deeper shifts. Japan's troubles extend far beyond energy. The country faces an escalating public debt crisis. Officials recently declared the situation dire, with government debt exceeding 260% of GDP, the highest ratio among developed countries. The yen is weakening, inflation is rising, and the overall economy is under severe strain. The Prime Minister has even admitted Japan's fiscal condition is worse than Greece's during its darkest financial crisis. The US response? Deafening silence. No financial support, no public statements, no diplomatic gestures. This is despite Japan's decades-long role as one of the largest financiers of the US economy. Its massive holdings of over $1 trillion in US Treasury securities have helped fund America's wars, bailout programs, and government expenditures. Now faced with crisis, Japan is met with indifference. This silence is forcing Japan to reevaluate its strategic relationship with the United States. Why should it continue to support the dollar if the US refuses to support Japan in return? The signs are becoming impossible to ignore. Japan is shifting away from Washington's shadow, and other nations may soon follow. The long-established world order, built on dollar dominance and Western alliances, is under unprecedented strain, and the coming changes could redefine global geopolitics for decades to come. The US government may soon begin selling off its bonds to shore up its own economy, and if that happens, the fallout could be massive and far-reaching. Interest rates in the United States could spike dramatically, pushing borrowing costs higher across the board. At the same time, the US dollar might weaken significantly, losing value against other currencies. Other countries, watching closely, especially after Japan's recent moves, might also start unloading their holdings of American debt, accelerating the pressure on the US financial system. Meanwhile, a shifting global strategy is unfolding. Japan, despite long-standing political and trade disputes with China, is signaling a willingness to draw closer economically. At the same time, Tokyo is deepening its relationships with other Asian nations, gearing up for a future where it must depend primarily on its own strength, rather than relying heavily on the US or Western support. Simultaneously, the BRICS nations, Brazil, Russia, India, China, and South Africa, are making moves that were once whispered only behind closed doors, but are now coming into the open. These countries are turning their backs on US Treasury bonds, historically considered the safest investment, and are instead starting to buy bonds denominated in Chinese yuan. Brazil led this charge, issuing bonds not in the traditional US dollar but in yuan, marking a major shift in global finance. This isn't just about money, it's about sovereignty and national security. After the US froze Russian assets and cut Russia off from global payment networks, many nations began to fear that in any future conflict, their own funds might also be frozen or restricted. Brazil no longer looks west for financial support, but instead turns east to China, which offers more favorable terms, fewer restrictions, more flexible interest rates, and access to a massive, rapidly growing financial infrastructure. This move allows Brazil to reduce its exposure to the risks inherent in the dollar system. Brazil isn't alone. India, South Africa, Turkey, Argentina, and others are watching intently, with some preparing to follow suit. Across the global south, bonds denominated in Chinese yuan are increasingly perceived as safer and more attractive alternatives to their American counterparts. China has been preparing for this shift for years. Its central bank has developed extensive yuan-based settlement systems, signed multiple currency swap agreements, and made it much easier for foreign investors to enter its bond markets. For decades, the United States dominated the global economy because everyone needed the dollar. But that dominance is slipping as more and more countries grow tired of depending on policies decided in Washington. When the US hikes interest rates, it inflicts pain on other economies. When sanctions are imposed, access to dollars can disappear instantly. This is driving BRICS countries to pivot toward the yuan as a way to protect themselves and gain economic independence. And this isn't just about buying bonds. Chinese banks are actively helping BRICS members not only issue yuan-denominated bonds, but also build comprehensive financial operations using the yuan. Recently, Brazil announced plans to issue panda bonds, bonds denominated in yuan, signaling a watershed moment in the global financial system. Brazil is a major player. Its decisions carry weight. If it successfully raises capital in yuan, others will follow, potentially initiating a prolonged global shift away from the US dollar. This shift spells serious trouble for the United States. When demand for Treasury bonds wanes, the government must raise interest rates to attract buyers, making borrowing much more expensive. With the US national debt nearing a staggering $37 trillion, even slight interest rate hikes could add hundreds of billions to annual interest payments. The dollar won't collapse suddenly, but it is steadily losing the privileged status that once made it the backbone of the global economy. The most alarming scenario is that if the US can no longer attract foreign capital, it may eventually struggle to pay its own bills. Japan's situation is equally complex, especially in its bond markets. Yields on long-term Japanese government bonds have surged sharply. The 40-year bond yield recently hit a record 3.07%, and while it has dipped slightly to 3.018%, it remains about 70 basis points higher than at the start of the year. Yields on 30 and 20-year bonds have also climbed by 60 and 50 basis points, respectively. These may sound like small changes, but in bond markets, they represent a significant and dangerous shift. As a result, Japanese investors are repatriating their capital in large volumes. In 2024 alone, they bought a record 28 trillion yen, around $180 billion in Japanese government bonds, while slashing their investments in American and other foreign bonds by half. This massive capital outflow, money fleeing the US and returning home to Japan, is driven by the newfound appeal of Japanese bonds with higher yields. All of these developments point to a single undeniable reality. Trust in the US financial system is eroding fast. This trend is visible everywhere, from Tokyo to Sao Paulo, from BRICS nations to the entire global south. The key question now is what Donald Trump will do next. Will he attempt to rebuild trust and restore stability, or will he escalate economic confrontations and deepen the divide? This story is unfolding right now, and it may mark the collapse of the old global financial order and the rise of a new one. Stay informed, stay alert, and watch closely as the world's economic landscape transforms before our eyes.